And welcome to Talkenomics Live. It is Hump Day. What is the date? It's actually July 11th. It's my dad's 93rd birthday. Happy birthday, Bappa. I said July. See, and I'm the one who makes fun that he's got 93 years and doesn't remember things. It's June 11th, July 11th. You know where my mind is. Hello, everybody, and welcome to Talkenomics Live, streaming to you from Brooklyn, New York, one of the largest cities in the tri-state area. Sell in May and go away. I just got to tell you, for all of the action in investing right now, there doesn't seem to be a whole lot of action. Since Memorial Day, it seems as like people have gone to the Hamptons, at least in this part of the world, or if you're in South Florida, they've gone down to Key West, and they're still smoking what they used to smoke for a lot cheaper in Key West when it was illegal, and they haven't woken up yet. I mean, the markets today were essentially flat. We have basically recovered the losses. In some cases, you're probably ahead from Liberation Day back in April. So where do we go from here? And we slugged this episode of Talkenomics Live, broken bonds, smart bets, because there's always a way to make money. Someone will always make money, especially if you're a hedge fund guy, because 2 and 20, whether you make money or not, they're going to make money. But let's talk about how you can make money. And to do that, our first guest is a recovering New Yorker who moved to South Florida almost 3 decades ago. He is the chairman and CEO of Access Capital. Joe DeGrossa Jr. is joining us now live from Coral Gables, Florida. It's good to have you here, Joe.
Thanks, Adam. Great to be here, and happy birthday to your dad.
Thank you. Thank you very much. Yeah, 93 years it's a pretty good run and still going strong. So I think it's South Florida living, because he's a native Floridian, which is, my people, he was there before it was the promised land. And I'm not talking Boca, I'm talking Florida. Gotcha. So let's talk about what's going on in these markets. And I think, there's a great deal that we can zero in on, but I want to talk with you about the fact that you've talked about a trade realignment in 2025. And since Liberation Day, the Trump administration has been realigning, whether you like it or not, or agree with it or not, the way we do business globally. What do you mean when you say 2025 will be the year of trade realignment, and how does that set us up for 2026?
Well, a couple of things. First of all, I like to say I don't have a dog in the hunt. I'm an independent, so I just want to state that I'm not a Trump guy. I'm not an anti-Trump guy. Mm-hmm. I'm just looking at the facts and circumstances right now. And, I think, I have to say President Trump, in my view, is taking a very smart approach. I think he's looking at 2025 as the year that, all bets are off. There could be market dislocation. He doesn't really care. He's going to do what it takes to get our, trade aligned with other nations. And I think he's, my personal view is he's right. I don't agree with him on a whole bunch of things, but on that, I do agree with him. So I think his approach is going to be 2025, let's slug it out. He wants to get everything, well positioned for a great 2026 for the midterms.
All right, so let's talk about what's coming down the pike, because we're literally 6 months till 2026. Yeah. So if it is kind of this, it feels like the summer doldrums. It mm-hmm. feels calm. I know that there are deadlines coming our way with tariffs in July and then in August. How do you position right now? And you as as someone who is managing huge amounts of money, and then for someone like me, who's a do-it-yourself kind of person and doesn't have huge amounts of money?
Well, look, my view is to take a long-term view. It's really that simple. The magic of compounding is a wonderful thing. So if you can do it in a tax-efficient way, even better. But, when I look at the markets, I've been in both worlds, meaning the public markets and the private markets. I spent 10 years at Payne Weber, 86 to 96, and in 96, had the job of a lifetime. I moved into private equity, and I've been in private equity now for 29 years. So 39 years, in the public markets and private markets. And, when I look at relative value, the private markets just look a whole lot better to me. Even after giving effect to your comment about the hedge fund guys getting 2 and 20, the best private equity managers are also getting 2 and 20, but they're worth it. And I look at relative value when the market is, not just at an all-time high in an absolute basis, but from a PE perspective, we're way above the mean. And I look at the private markets and I say, look, there's still some great opportunities, particularly if you can be selective with managers.
So let's talk about private markets, because how does someone like me take advantage of the return? You have to have a longer term outlook, do you not, if you go into private markets? And quite frankly, I don't know if I have I would like, well, Dad's 93, so I probably have a 30-year outlook going ahead, but knock wood. But how do I gain access to that? Do I need an intermediary? And I, by the way, just so you know, I would use someone like you because I don't know what I'm doing out there, but I would like the opportunity to have access to that. How does that play out?
Well, first of all, your dad is a great case in point. You are probably an even better great case in point with the following perspective. The average 50-year-old today is going to live 3.5 years longer than a 50-year-old of 30 years ago. And a 40-year-old is going to live close to 5 years longer. So people are just living longer. And when you think about matching assets and liabilities, you have to start thinking about that relative trade-off between illiquidity and better returns, because nothing is free in life. But if you have a long-term investment horizon, think about the money you're going to need in your 70s, 80s, and even 90s. If you're in your 50s, socking money away, some percentage in a private investments makes all the sense in the world. Now, you're not going to put your, all of your capital, but 10, 20, 30% of your capital, if you're a 50-year-old, if that's your long-term money, it should be in private investments. That is the place to be.
So let's talk about that. And I just want to remind the people who are watching us on X and on YouTube, on LinkedIn, put your questions for Joe into the chat, and we'll make sure we ask Joe the questions you want him to answer. I'm more than happy to share that role with our guests. But forgive me, because I think there are probably people out there like me. When I hear the term private markets, I get confused sometimes because I also think about alternative investments. And we're talking about two distinct, different kinds of investing. I mean, you're talking about giving me access to venture capitalists where they're going. That's what we're talking about?
Well, that's just part of the story. So, this term alternative investments, the way I've always thought about it is there's two distinct buckets. There's the hedge fund world, and then there's the private investment world. And when you think about hedge funds, what are those guys really doing? They're going out and they're making bets on public markets. And the trade-off for them is they've got liquidity, but they have no control. Private markets are just the opposite. The investor has control. And when I say the investor, I'm typically talking about a GP sponsor. They have control, but they don't have liquidity. So the private markets, think of companies. They could be early stage companies, which are typically venture capital investments, riskier. So you want to be, in a very diversified pool or portfolio of those investments. You also have traditional, back in the day, we used to call them leverage buyouts. They're sort of euphemistically today called private equity. But those are investing in, mid-sized companies, large companies that happen to be private. And therein lies, I think, the best opportunity. But when I think about privates and what Access Capital is doing, is we're offering private investments on the equity side. So think, as you said, venture capital or traditional co-investments in typical leverage buyouts or credit. And on the credit side, we think of direct lending. We think which is lending to companies, once again, private companies, basically taking over the role that banks traditionally played, that are taking on less and less of a role. We also think in terms of opportunistic credit. Think of special situations. The risk profile is a little bit higher, but the return profile is also higher. Yeah, please.
I want you to finish that, but I want to break down what you just said, because let's say hypothetically you started life in South Florida, you worked very hard, you saved, and then you wound up in your 50s, and you had some money to the side, and you were listening to our discussion. You think, okay, maybe this is something I should do. What's the entry point? Are we talking 25,000, 50,000, 200,000? What's legitimate entry point for someone who wants to get in on this kind of private market investment?
Well, it's a great question. Traditionally, private funds have been limited to, large institutions and very high net worth investors. And the rules of the game are changing. So you're seeing a wave, particularly over the past, 3 or 4 years, of what are called the interval funds. These are registered vehicles. So you're registered with the SEC. You fall under what's called the Investment Company of 1940, the 40 Act. and you can invest as little as 25,000, and you have periodic liquidity. Now, I want to make it very clear, it's not as liquid as a money market fund or even a mutual fund. So you are paying a price. You're going to be tying up your money, but there is an element of liquidity, and you can dollar cost average with 25,000 initially, put in 5,000 a month for the next however many months.
Mm-hmm.
It has some of the characteristics of mutual funds and some of the characteristics of those long-term primary funds that large institutional investors are in. So I think you sort of get the best of both worlds.
And if you were to do this, let's say we use your model of 25,000, do you have to be, I think, what is the SEC term for this, the qualified investor, or is it wide open to people?
Very good question. So think about it this way. Historically, you had to be what's called a qualified purchaser. You had to have 5 million or more of investable assets to be able to invest in a standard private equity or private credit fund. And the minimum investments were typically much larger than 25,000. What's interesting is these new interval funds that are coming out, and there's probably about 100 of them now, and they're growing pretty rapidly because of the investor interest. But you need only be an accredited investor. And as an accredited investor, the threshold is much lower, $1 million of investable assets,
Mm-hmm.
or there's an income test. So you either have, sufficient $1 million in investable capital, or you make 250,000 a year for each of the last 2 years. So, doctors and lawyers and, relatively successful people, not, multi-millionaires, but the average successful, man or woman can start deploying assets in a very thoughtful way in a private investment.
And no investment. In my day job, I point out, and we reject certain paid content that we try to partner with when they make promises of returns, because one, that's illegal. You can't promise the return. But we point that out to the clients, and they're like, nope, we're rejecting that. But it's legitimate to ask, what kind of return should I be expecting? So if I do this 25,000 with the dollar cost averaging, 5,000 a month for, let's say, the first year, what's my time horizon? Are we talking 3, 5, 10? And what is the legitimate, realistic expectation?
Well, I personally would suggest those assets that are earmarked for retirement, and I'm going to presume that for typical person, retirement is at least 10 years out. That the allocation should be, 10, 20, 30% of your overall assets, no more than that.
Mm-hmm.
And certainly earmarked for the long term. In terms of expected returns, the way, I like to think about it is, I want to get paid for the illiquidity. So when I think of equity, I'm thinking 300 to 500 basis points, or 3 to 5% more than the public markets. When I think of private credit, I'm thinking 1 to 3%, 100 to 300 basis points, versus what I can get in public debt. And those incremental returns compounded over 10, 20 years results in a massive differential in terms of that capital winds up being worth.
The one thing I've learned as I've gotten older is that a lot of people are very short-sighted, me included, although the glasses have become more far-sighted. But here's my question. We're in a volatile period. You're expecting, aren't you, the Fed to cut rates, and yet, they're going to meet next week, and the expectation is no big whoop, and probably not till the end of the year. So how do you deal with the volatility, especially if people say they're willing to be long-term? But my guess is that most people really don't have a longer than a 2-year horizon in investing.
Well, it's very interesting. I deal with a lot of financial advisors, both personally and professionally. And look, the job of the financial advisor is, steady the nerves of their clients. And you have to be a mid to long-term investor. I mean, short-term trading is a sucker's game, I believe. I mean, I've tried it for years. You have to think medium to long term. Otherwise, you shouldn't be in the game. If you need liquidity in 6 months, you should not be in the stock market. It's really that simple.
But getting back to that question I asked you about return, if I can get, we're going to have a 30-year auction, we're going to have a 10-year auction tomorrow, and our next guest we're going to be talking about bonds. But let me ask you this: if my risk-free return on a 10-year, forget that inflation's going to wipe me out, but it is roughly 5%. How much better, if I go with what you're suggesting, is my return going to be?
Well, look, once again, with all the appropriate disclaimers, if the risk-free is X, I want to be making, I want to look at what corporate credits are earning above the risk-free rate. So let's just say, by way of example, that's another 2.5%. So you're at 7.5%.
Okay.
If we're not looking at, call it 9 to 10.5% returns, I wouldn't be in private investments. The good news is there are a whole host of opportunities in the interval fund space and in the private credit markets in general where you can generate those returns.
All right. So let me ask you this. What are the most difficult questions you get from your clients right now? Because we have, we still haven't resolved the tariff situation. We don't know what's going to really happen with China. They're promising to sell us rare earth minerals for 6 months. Talk about having some leverage. How do you, I realize you got to have the cash and be able to survive more than 6 months, but how do you steady their nerves through a period like this?
Well, look, I happen to believe we're going to be going into, a golden age in the United States. We are reshoring a lot of our manufacturing. We're really creating a Western Hemisphere trading bloc. We've got most of the world ready to cut deals with us. The reality is international trade is not something the United States is nearly as dependent upon as, for example, the Chinese are. So we're in a great negotiating position. That's my view in general. My view is, we get to 26 and the market's going to be fine. I really believe that. So I'm happy to live with the short-term volatility. If there's a pullback, that's great news. We are going to be getting interest rate cuts. I think we'll get 2 of them this year. Powell's going to be out in May. I mean, I think he's the walking dead as far as Trump is concerned. So you're going to get a very, pro-Trump chairman in, for sure.
It's going to be Warsh, with the Estee Lauder's son-in-law.
There you go. So the bottom line is, a condition, and I hate to call it a condition, but it will be a condition for the next guy to get appointed, whoever it is, man or woman. They're going to be promising Trump, interest rate cuts. Pure and simple. It's going to happen. That happens in May of next year. Lo and behold, the elections are 6 months later. So I think it's going to be a very interesting time next year.
We get those interest rate cuts in 2026, and you're already predicting a really strong year for markets in 2026.
Absolutely.
Don't we just ignite inflation? Don't we? I mean, you're in ground zero of. It's not a real estate bubble because there's definitely demand. What article in the Miami Herald, or as my grandmother would say, the Miami Herald, and she was from New York. Go figure.
Well, she really is a local.
Yeah, but God bless her. No longer with us, but. They had in the Miami Herald, 50% of the people in South Florida can't afford South Florida. You drop interest rates, housing prices aren't going to come down; they're going to go up. So it sounds like almost a recipe for disaster in some of the healthiest economies in the country right now.
Well, we're in a bit of a bubble down here, which, by the way, I fully expect to continue because the demand for real estate in South Florida is not just driven by domestic demand. We're seeing demand out of Latin America, and I know, Adam, you lived here for a long time, so you know the influence of Latin American buyers here. But it's also coming from the Middle East. It's coming from Europe. It's coming from the West Coast of the United States. So I don't see that letting up anytime soon.
All right. I'm going to begin to wrap up with you. What is the most important thing you want people to consider? We've been talking about private markets. We've been talking about what, if I put words in your mouth, correct me, but essentially what sounds like is going to be a boom year in 2026 from your expectation. If it's going to be a boom year, why would I want to consider private markets when I could have the liquidity, or at least better liquidity in traditional markets?
Well, once again, it's all about the long term, and it's all about how you allocate a portfolio so it's diversified. And one of the good things about private investments is historically they deliver better returns and they help better diversify portfolios. And so once again, nothing in life is free. You are tying up your money. There is that illiquidity component where you're being compensated for that. And yes, I think the public markets will have a great year. I think the private markets are going to have an even better year next year. So it's all about the relative value.
All right, we're going to ask our next guest about long-term, but my last question to you, Joe, which dorm freshman year at Syracuse? I was Del Plain Hall.
I was Shaw Hall.
You were in Shaw.
Yes, exactly.
And if I said to you the toilet bowl, which dorm was the toilet bowl?
Oh, geez, gosh.
Haven. Haven Hall.
Yes,
Anybody watching,
right.
if you've
That's
got a
right.
son or daughter who's considering Syracuse University, get a drone, take an aerial shot of the dormitories and the university. You will see a building, and the architect must have had a sense of humor because it looks like you're looking down on a porcelain throne. That's what they built.
Very true. And Adam, it's great that we both went to SU. I miss it. I want to get back up there one of these days.
The snow is still melting, so it's waiting for you.
I can't wait.
Joe,
thanks so much.
Joe DeGrossa Jr., thank you so much for joining us from Access Capital. All the best to you in South Florida.
And happy birthday to your pops. Thanks so much.
Thank you. When we come back, we're going to be, well, we're not taking a break, but we're taking a little of a technical break. I want to let you know that some of the things that are coming up on Talkenomics. My talk this evening is going to be a call to Republicans, especially New York City Republicans. And let me give you the tease. Where are you? Where have you been since 1949? We're going to go there at the end of the program, and I'll probably put my foot in my mouth, but that's what you do when you're my age. The other thing is I want to give you a tease to something we're going to do on July 2nd. A lot of people, a lot of couples are turning to in vitro, artificial insemination and fertility doctors in order to create families and have children. We're going to have a special on Talkenomics. We are in touch with an internationally recognized doctor who's agreed to come on the program July 2nd and is going to take your questions, any question you want about fertility, about in vitro, about how this whole thing works. But there's an interesting catch to this story. That doctor, because when you do fertility clinics and in vitro, you have an egg donor in some cases, you have a sperm donor in some cases. This doctor was a sperm donor. And this doctor, 36 years ago, made a donation. And 34 years ago, the product of that donation found the doctor through a DNA test. They're going to be reunited on the program. So if you're thinking about fertility treatments and what this all means, you can ask any question you want of the doctor. You're going to be able to ask the biological child of this doctor what the experience was like growing up with a dad and then finding out you had a biological dad, and how this has played out and what you should know as you go into these procedures. We're going to probably call or slug the segment No Secrets, but I'll tell you more about that as we get closer to July 2nd. But now let's bring in our next guest, because we want to talk about bonds. I'm risk off when it comes to investing. And I like bonds, but bonds don't like me. And that's why Mike Dixon from Horizon Investments is joining us right now. And Mike, thank you for being here.
Yeah, Adam, thanks for having me. So let's talk about some bonds.
Yeah, well, let's talk about that, because as you heard our last guest, we were talking about long-term. And for someone like me, I have unknowingly been using money in short-term bond investments. That's done well. But now some of these are going to mature, and I laddered without realizing I was laddering, but I took cash and did this. But now they're maturing, and I don't know what to do. We're going to have a 10-year auction and a 30-year auction tomorrow. And when I read your notes about forget the long term with these things, I kind of get worried. I freak out. So, as Lucy Ricardo would say, explain to me what's going on.
Yeah, sure. And I think some of the topics that you and Joe just talked about, obviously play really well into this, especially when you're talking about planning for retirement, right? And as he was talking about, folks just living longer, like the longevity is a great problem to have, but it's definitely an investment problem we need to think carefully about. You look back over the last 40 years and, absent just the last few, we've had just this secular decline in bond yields. And you've had a real tailwind to the total return of bonds, right? So a lot of folks that are retiring today, like their entire investment experience over their working life from the early 80s on has been bonds are the place to be. And, as a result, you've seen, target date type funds get really popular. And as folks get older, the general way of thinking is, hey, I need to be more and more in bonds because I'm retired, I'm not working. I actually, just really don't agree with that thesis. And I'll tell you why. Just a couple key points. I mean, tactically in the short term, we definitely haven't seen bonds providing the diversification benefit that they used to, right? So they have not reliably been that safe haven that they were during that secular decline in yields for those 40 years. Also, when you just look at the yield curve shape right now, I mean, a 3-month yield and a 10-year yield is basically the same as we sit here today. And if you go out even longer on the curve, you get a tiny bit more premium, but wow, the volatility you get with that duration exposure is quite large. I mean, when you're looking at 20-year bonds and longer, I mean, this can be as volatile as the S&P 500.
But when I read your notes, and it was that you just said it, but this is what made me go, uh-oh. The 3-month yield and 10-year yield roughly the same. At what point do we get quiet intervention from the Fed or some other branch of government and try and change these yields? Because that's not sustainable, or is it?
Well, I think that from an investment perspective, there's a pretty big implication there, and I think you kind of just alluded to it as much. I think short term is probably where you should be putting your money when these things mature, not necessarily on the long end. We have seen the classic kind of term premium or the additional yield that long term bonds, that yield that they provide relative to the short term. We have seen that slowly tick up. I think some of the spikes we saw this year is probably for the wrong reasons, which is, concerns around budget deficits with, the tax bill that has made its way through the House. It's probably not the greatest reason to see that kind of move up. So we're going to want to see that move up for much more healthy reasons, which is, most notably just pure economic growth expectations. That would be a good reason for the long-term yields to move up relative to the short term. But look, I think the implication is why would you want to take on the additional volatility, which can be significant without the diversification benefits of the long end, when you can stick to the very, very short end of the curve, which honestly provides a lot of liquidity opportunities for you as well if there is market pullbacks, which we've definitely seen a lot of that headline-driven volatility this year.
I don't know the true expression. I'd rather be lucky than right. I got very lucky because I did not realize what we were doing when we were doing this short-term play with treasuries, but it worked out well. But now the question I have is high-yield corporate bonds. Is that something? I mean, what should the horizon be on that? And it clearly comes with some risk. I mean, I'm just going to throw out a hypothetical here. Buddy of mine just got walking papers from Paramount Global. They're laying off staff. There's a huge debt load they've got to deal with. And this individual is telling me, people are talking about bankruptcy. I don't know what's going to happen with Paramount. But corporate debt, that evil genie's out there sometimes. So is high yield bonds, is it only corporate debt I should be looking at? Where else could we look?
Well, when I think about the broad bond universe, I mean, you're talking about the short-term cash, like, treasury, money market, bill, those investments. I would lump investment grade bonds, treasuries, mortgage-backed securities, all of that investment grade stuff into a bucket. And then, you have the high yield kind of corporate market. Right now, like I like the two ends. I don't really like the middle because of that duration exposure. Now you look at high yield spreads, and they actually are below where we were just slightly, pre-Liberation Day. At first glance, you might scratch your head a little bit and say, well, have we really priced all of that risk out of the market? But those spreads being 300 basis points with the, a solid economic backdrop, provides you a solid yield. I think the high yield asset class overall has actually been, an incredible risk return trade-off. I mean, you're able to get the 7 to 8% all-in yields with volatility that's roughly 20 to 25% of that of the equity markets. I mean, even in this recent pullback we had, yes, high yield bonds pulled back about 4.5% compared to the 20 in the S&P. And of course, they're going to have some of that, kind of equity beta, equity risk exposure. But on just a pure risk return trade-off, that has really been a very, very strong play. And I think as long as a recession is kind of not in the cards and in your thought process, I do think that's a good place to clip some coupons and earn a quite attractive yield, again, above inflation, which is what we really want. And the economic data has been strong.
Yeah, jobs are holding up. Inflation is seems to be under control,
Yep.
which all of those things are lining up appropriately. Last question on bonds, and then I want to get into what sectors you like.
Yep.
But I talked with the last guest. I was talking with Joe about risk-free, U.S. Treasuries. Does anyone really care? Do investors care that we just got downgraded? U.S. debt, and does anyone take, because we have not passed the tax bill yet, and I'm hearing people on television, and I used to be on TV, so trust me, don't believe people on TV, talking about doom and gloom if we pass the tax bill. Do the investors care about the debt load that the United States is carrying?
Well, I mean, I guess you asked a couple questions there, but overall, when we look at potential debt burden, I mean, over the long term, of course, that would be a problem. But at the same time, if you can spur economic growth and kind of make up for some of that loss in revenue, then that's going to really be the trade-off. Certainly something to worry about. But at the same time, that's why we have all these economic data releases. We're going to be able to track this stuff in real time, and and see what the ultimate impacts are.
All right, so let's turn to equities. What sectors should people be following? Because most of us, those of us who are not professionals at this, we get all excited with the Mag 7. I mean, Tesla, Elon Musk is puckering up and kissing what, and seems to be back on the upswing. But forget the Mag 7. Where should we be looking?
Yeah, look, I think one place that has been relatively, overlooked and it is really a great entry point at this point is the small mid-cap space here in the U.S. So there's a lot of household names, kind of in that space that I think folks would be, surprised to hear of. But at the same time, when you're looking at just broad asset class exposure, those areas of the market have really been tempered in their overall returns due to rates kind of being high and certainly not coming down in a hurry at all. Your smaller mid-cap companies will tend to have a little bit more sensitivity just from a cash flow to debt service type of ratios. And so they have over the last couple of years been quite sensitive to the higher overall level of rates. And as where we sit today, I mean, they're still negative on the year, well below large cap stocks. I think that makes for a great entry point for several reasons. One, I mean, you've definitely seen some broadening out in earnings growth and earnings breadth in those markets. And that's, of course, going to be extremely helpful over the long term, where just with inflation this morning, right? I mean, Fed hikes are certainly nowhere in the conversation. But you go back 6 months and you couldn't necessarily say that.
Right.
So I think you've got a slight downward bias in yields, although I don't think that it's going to happen in a hurry. And then just look at the overall administration's policies. They're very domestic focused. A lot of this tariff drama is not going to impact very much some of the more domestic and smaller companies that are really insulated from that because they're not doing business overseas. But, and the deregulatory backdrop as well, I think is going to be very helpful.
Well, let's talk about, so the Russell 2000 is off, 3.5% year to date. Doesn't that usually mean we're lining up for a recession, or do we need to, the past is not indicative of what's going to happen in the future? And even though it's down, you talk about an entry point. Within the Russell 2000, should I be looking at software companies? I mean, is there any one particular venue you would direct my attention to?
I think consumer-focused areas would be one kind of subcategory in the small mid-cap space, just given the resilience of the consumer and the resilience of the labor market. Of course, that's going to be the dominant driver in GDP growth. And I think a lot of the policies that are in process here, the goal is to boost that tremendously. I think that would be a great place to look for. I think also if you want to get really into the weeds, thinking about the AI theme. Okay, so this massive productivity enhancement technology, I think we've kind of moved on from that being just about semiconductors, and we're kind of moving on to a phase where hey, where can I find companies that are actually able to make these huge productivity enhancements that are going to fall to the bottom line? And I think that there's a lot of companies, a little bit, underneath the surface a little bit in that small mid cap space that could be really poised to take advantage of these types of technologies. And software and services type companies, I think would certainly fall into that category and would be a great place to look for in the small mid cap space to get advantage of, again, some of this kind of cyclical economic setup that I'm talking about, but also take advantage of this AI narrative, which is going to be a dominant theme for a while, especially as this technology continues to mature.
I know compliance issues. I don't know if you're allowed to actually name any companies. I'm definitely not going to ask you to make a call, buy, hold, or sell. But
Sure.
Let's talk AI. If I wanted to look within the small to mid cap companies, are there companies that might be involved in the rebuilding of the U.S. grid? Because that's one avenue to capitalize on AI. You don't have to have software. You got to have the electricity to power these AI servers. Are there companies within the small and mid cap that I should be looking at? And if you're allowed, can you say who they might be?
Yeah, I'm probably going to refrain from dropping tickers on here, but I
That's
will.
fine.
I think you brought up a great point. And absolutely, I think when you're looking at just infrastructure overall, so infrastructure names that are going to be involved in the build out of, just these technologies, these data centers, this, power consumption, other, in industrial infrastructure focused exposures is an absolute great play on what we know, the administration is going to be wanting to put into place, as well as what is needed for this AI to really, penetrate more and more sectors of the economy and really grow. So I do love infrastructure type plays in kind of that energy materials, kind of in industrials like subsectors in the small mid cap space. Could be a great place to look for and kind of get the tailwinds of kind of, both of these themes that I'm talking about, not just the good entry points for smaller cap stocks, but also that, AI narrative that has been so dominant for a couple of years.
And as I start to wrap this up with you, I want to talk about tariffs. We have some deadlines out there, July 9th. We have August 12th. It's clear that the Trump administration, I know those opposed to President Trump will make fun of the back and forth with tariffs. Those in favor of President Trump will tell you that's the negotiating strategy. How do you make heads or tails of this, or does it not really matter that we have these deadlines looming?
I actually don't really think it matters. I mean, you heard, Besant today who was talking about how if countries are, actively making good progress towards negotiations, like the plan is to just push the deadline out. And it's interesting. I mean, even just looking at the very, very short term, the market reaction this morning, right? There's, headlines before markets open about this deal that's in place with China. It's a great deal. Something that, quite honestly, I saw the headline. I come into sit down at my computer. I expect to see stocks up a lot, and barely budged. And of course, we didn't even hardly, we went nowhere on the entire day. And I think that's really telling. I mean, just looking at that price action, I think the market's getting a little tired of the back and forth tariff conversation. I think the market's in the process of moving on, honestly. Over the course of the last couple months, I think Trump's made it very clear that, this is a negotiating process. This is a negotiating tactic. I don't think he's going to hold the market hostage at all costs. And the market knows this. And I think most of that's in the price. So I don't think that these deadlines are going to be as big of a deal as we might have thought they were initially. And it's very likely that you're just going to continue to see things get pushed out. And, over time, we'll get developments. But there's just a lot less sensitivity, I think, to that right now than, of course, there was, back in early April.
Okay, and last question for you. What's the headline you're watching?
The headline I'm watching right now, I think, is, just really going back to the fundamentals. So, I think about what the market, what's the next big theme going to be, right? Is it
Plastics?
I think the market's moving on a little bit from tariffs. The Fed really kind of out of the picture right now. The economic data has been pretty solid. I think it goes back to company earnings, and I think it goes back to us watching for how these massive technologies like AI can penetrate these sectors and companies, and really seeing where that's making a big difference, because I do think you are really going to see some big winners that make really good use of these technologies. And so I think it goes back to seeing how that flows through to the company earnings.
Mike Dixon, Horizon Investments. It's a pleasure to have you here on Talkenomics. I hope you'll consider coming back, and all the best to you.
Absolutely. Thanks a lot.
Be well. All right. So it's time for my talk. And this is the moment where I get to put my foot in my mouth, although it's hard to put your foot in your mouth when it's just obvious and you look at the facts. So let's talk about this. And what I want to say very quietly and simply is, hey, New York City Republicans, where are you? Why are you asleep at home and in bed? And you've been asleep and at home and in bed since 1949. So let me just give you the very quick headlines here. Democrats have controlled the New York City Council since 1949. Now, I realize politics today, 75 years later, 76 years later, is different than it was back in the late 40s, 50s, and 60s, because there were Republican mayors, there were legislative bodies that compromised with leadership, and the city progressed. But here's why I bring this up. We've essentially had one-party rule in New York City, and you should just know I love this city just about more than anything else. And there are a lot of cities in the United States I love. Yeah, I might have dropped too much acid in college because I love Cleveland, Ohio. But New York City, it's the best, and I never did acid. It's just a joke. But here's the deal about New York City. People in New York City, and I have friends. I have one friend. He's a Republican. He was the first openly gay person to run as a Republican for city council. That was about 20 years ago. He lost. But Democrats and Republicans are all complaining about the same things in New York City. You go to a CVS, you go to any store, it's behind lock and key. People, although crime is overall down, people don't feel safe in the city. There are all kinds of quality of life issues going on. The rent is too damn high. They've been saying that in New York going back to the late 1800s. But once again, let's talk about now. Because the person I believe is going to be the next mayor of New York City is a socialist. He's a member of the Democratic Socialists, and we won't get into whether his policies are right or wrong. But the only question I have is, how are you going to pay for this? And Zoran Mamdani, there you see him, Mamdani rather, is probably going to try to raise taxes. Forget the fact that everything he's promising, really hard to deliver, like free buses, which, by the way, if you could pay for it, probably is a good idea, but you can't pay for it. And the state has the controlling interest in the MTA, so good luck with the bus thing. But then he's talking about freezing rents. We have 1 million apartments in New York City, which has a housing crisis. 1 million apartments are rent stabilized. He's talking about freezing rents for those 1 million apartments. That's 44% roughly of the apartment stock in New York City. Now let's talk about this. The people who've controlled New York City since 1949 have delivered this utopia, and I do love this city, but it is frightfully expensive. They've delivered this to us, and now, since it's having some problems and not working, they're promising to go even further to the left. How's that going to work out for you? I mean, one-party rule does not work, and that's what the purpose of saying, hey, Republicans, where are you? This is low-hanging fruit. How can you not capitalize on this? People are pissed off about the quality of life issues. You got to go into the drugstore and ask someone to get you the shaving cream. They're upset with the homeless people living in subway stations, not saying we don't have to take care of those who are less advantaged or disadvantaged in our society. But the people, the one-party rule that has done this, has done it because where are the Republicans? Wake up. This is an easy one to start winning. And to say because the 5 boroughs are heavily Democratic is not an excuse. Because talk to Democrats. They are saying the same things that Republicans are saying, which is, what is going on here? And Republicans, asleep at home in bed, is no way to handle this. Wake up, put forth candidates who can lead this city, and let's get back to a 2-party system, which would be the best thing for New York. We'll see you next week on Talkenomics.